Remember this, you can't have a healthy economy or a healthy country, a healthy nation, without a healthy and vibrant middle class. And we no longer have that in this country.
Michael Pento, president and founder of Pento Portfolio Strategies. It is so great to welcome you on the show. Thank you so much for taking the time to join me today.
It's my pleasure, Julia.
Well, it's so great to have you, especially this week. We had the FOMC this week, and we just got the jobs report as we're recording today, Friday, May 3rd. And I got to say, Michael, you're one of the most requested guests that I've received from my audience. So I'm just thrilled to have you. And I'd like to start where I always start with my guest, and that is to get your big picture, macro view, the framework in which you're looking at the world today. And one of the things about this show, Michael, is you can take all the time you need to set the table when it comes to that macro picture.
Okay, well, first, the first thought in my mind is that I heard Austin Goolsbee today on Bloomberg, and he was talking about what a wonderful job he's done and the Fed has done on inflation. And I said to myself, wait a second, inflation is rising at 3.5%. Annual rate, year-over-year change. And I guess he's doing victory laps on that, but it came down from 9% to 3.5%. But inflation has already bankrupted the nation. The middle class is eviscerated. So 78% of Americans are living paycheck to paycheck. 50% have negative net worth. And so let's just take an example. Home prices are up 50%. This is not my opinion. This is the data from Case-Shiller, 50% since COVID, 2020. So, home prices are unaffordable. A basket of food is up 37%. So people can't afford to eat. People can't afford to buy a house. The real estate transaction market is frozen. And yet the Fed is taking victory laps at 3.5% inflation. So in the second derivative sense, inflation is rising at a slower rate than 9%, but it's rising at 3.5%, which is much higher than 2%, which is their goal. But more importantly, inflation is higher, is rising from a rate that has already bankrupted the middle class of the country. It means prices are already unaffordable. So that's the problem that I see right now. And that's why you look at all these earnings reports. There's from Expedia to Booking.com to Starbucks to McDonald's to Walmart. They're all saying the same thing. The consumer is under a lot of pressure. So what we're doing here, Julie, is we're recycling the debt, which is through the roof. Consumer debt. It's just like household debt. It's $20 trillion. It's up from $15.6 trillion just 2 years ago. So the nominal amount of debt is through the roof. The U.S. economy is insolvent. Banks are insolvent. The regional banking index will prove that beyond a shadow of a doubt. It was bailed out by the Bank Term Funding Program, but banks' assets are underwater. Mortgage-backed securities or treasury holdings are all underwater. The U.S. government is insolvent. We're cycling rates at much higher rates than they were, when the U.S. Treasury was 0.33%. Now the U.S. U.S. Treasury is what? Is a 4.6, 4.7% on a 10-year duration. So 20% of the listed companies in the United States are zombies. 40% of the Russell 2000 companies are zombies. Don't make any money at all. So we're cycling the economy through these interest rates that are much higher. And though my portfolio, I manage money for a living. Right now, we are not net short in the portfolio. If rates aren't able to come down quickly, and I mean interest rates both on the long end and in the short end, so it's not a monolithic term structure here. Interest rates there's duration. So short-term rates, the Fed controls. Long-term rates, they do not. So if rates don't come down, across the yield curve, relatively quickly, the economy's in for a big trouble. And you look at the Dodd-Frank payroll report today, 175,000 net new jobs were created. Household survey showed about 25,000 jobs were created. ISM manufacturing back into contraction after being in contraction for many, many months in a row. I think it was 21 or something like that. And now the service sector was released today. That has come into contraction with the employment subcomponent also in contraction. So, yeah, I mean, are we in a virulent recession right now? No, we're not. But the economy is anemic. Growth rates are falling. The GDP growth rate was cut in half, by the way, from Q4 to Q1. And you see the inflation, there was an inflation component in the ISM services sector released today. The subcomponent of prices was rising at a much faster rate. So we have a condition right now of stagflation, even if Jerome Powell doesn't want to admit that's the case.
What a great frame up to the conversation. And you're right, Powell pointing out he doesn't see the stag or the inflation. But I want to get your take on how you think all of this plays out, because you're right. There's been that pervasive narrative of a strong economy. You highlight a lot of areas where that's certainly not the case. I've had a lot of guests who said similar things. So for you, Michael, how do you think this ultimately plays out, and how would you start to position for the scenario that you see playing out?
So I think by the second half of the year, we're going to at least hit the flat line on SAAR, seasonally adjusted annualized rate of GDP growth, if not actually have a negative quarter. We might get some non-farm payroll prints that are in the negative too in the second half of 2024. And I think that was going to cause the Federal Reserve to start to lower interest rates, without a doubt, in my mind, at least once or twice in sometime this year. The question I have, here's a salient question I have. If the Fed starts to cut interest rates, when you have a condition where you have inculcated that you are absolutely incapable, the Fed is absolutely incapable of bringing inflation under control, anywhere near 2%. And you've had years and years, this by the way, so March marked 3 years where the Federal Reserve was unable to reach 2%, bring inflation back to 2%. It was north of 2% for 3 years and going further away in that direction. So the calculation, the assessment is going to be made from investors like, wait a second, you can't bring inflation back to 2%, even though it's already at a level that's bankrupted the middle class. You can't bring the rate of change to 2% without destroying the economy. And if that's the epiphany that's reached by investors, then it's really bad news for a stock market, which has never been, outside of the years 2020 to 2022, outside those years, has never been more expensive. You look at the price to sales, median PE ratio, total market cap to GDP, risk premium are now negative. So the market is massive, and not just by a little bit, it's massively overvalued. And if you can't bring inflation under control without killing the economy and bursting asset bubbles, which my calculation, home prices have to be reduced by 40%, and coincidentally, the S&P 500 has to contract by 40%. 40% on both home prices and stock prices to bring them back to historical means. The relationship between total market cap of equities to GDP and median home price to median family incomes. So if that happens, you'd bankrupt the entire banking system. There wouldn't be a pension plan that would be solvent in this country. So if you can't do that, then my thought process goes like this. So if you have to inflate, if you have to then bring the Fed's balance sheet, which was once $700 billion in 2007, and then it went to $9 trillion, you got back down to $7.4 trillion, and you're dramatically cutting the pace of QT now, more than even anticipated, more than telegraphed. And what happens if this balance sheet goes to 10 trillion and 20 trillion and 30 trillion? What happens to the value of the dollar? What happens to inflation? I think we could be setting ourselves up for a period of intractable stagflation, the likes of which we have never before seen in this country.
Which is historically the worst environment for all assets. Like, what do you do in that scenario?
So stagflation is very tricky to invest because you can't really short the market. Inflation has a way of, in nominal terms, bringing stock prices higher. So you have to eschew the target date portfolio, the 60-40 portfolio. and you have to become very active. But you should understand that in sector 5 of my 5-sector investment spectrum, stagflation and tractable inflation requires you to overweight energy, overweight base metals, overweight gold, short the bond market, short the dollar. These are the things you would want to be concentrating on in a stagflationary or intractable inflationary environment. And the inverse of that, the converse of that, is in sector 1, where you have deflation, disinflation, recession, depression. You just want to have cash. You just want to have very short-term treasuries. You want to be overweight treasuries. You want to own the US dollar, and you want to be short the market, because there's nothing like deflation to destroy asset prices. So that's why stagflation is very tricky. You have to be actively managing it, and you can be short at times, but not consistently short. Because as I said, when the dollar, look at Weimar Germany, Zimbabwe, Hungary, when these hyperinflationary economies, again, I'm not guaranteeing that we're having hyperinflation here in the United States. I'm not saying that. But if we enter a period of time where inflation runs intractable, double digits for a protracted period of time, you're going to have a hard time shorting the market for very long, because just, stocks are priced in dollars and the dollar gets destroyed.
Mm-hmm. I can tell you, Michael, I'm a millennial who would like to buy a house, but I feel like it's just insane right now. And I want to be patient and not do it. I don't know. I just would like to not put myself in an unfortunate position. Do you think that is it likely that we'd see the housing and also equities, the contraction of that 40% that you point out? Is that a likely scenario, or is it just what it needs to do to get back to the historical
So
means?
it's the latter. So I hope for home prices to become affordable once again. And I didn't mention taxes and insurance and maintenance costs, which makes I just quoted. So the home price to income ratio right now is 5.5. It was 2.8 in the year 2000 for reference. So it was 5 at the peak of the other bubble, the great, the global financial crisis, real estate bubble. The peak was 5 in 2000, summer of 2006. So the home price has to fall. But then what about the taxes? Well, the taxes would probably fall with it, hopefully. But what about the insurance costs? What about the maintenance costs? So, and who's to say they would just fall back to a historical mean? They usually fall below that. So the question is, will that happen? If that were to happen, that's where the market, the gravitational forces of a free market, of deflation, want to take hold of these home prices, because they're just like, this you're a successful young woman. You want to own a home. This shouldn't be a pipe dream for you. It should be very affordable. But, when you look at that, the calculation, do I want to own a home or do I want to rent? Well, renting is much more affordable now because there's no taxes with rent. Right? There's no insurance with rent. It's supposed to be part of the rent, but it's just, owning a home is like 40, 50% more expensive than renting right now. That's the data. So it should fall by that, at least that, to be put back into historical norms. But guess what? If that happened, what bank on the planet would be solvent? There wouldn't be one. The economy would be not in a mild depression. It would be it would make the Great Depression look like a Sunday picnic. So Powell's he's not going to stand there and let that happen. This guy's itching right now to cut interest rates. He can't wait to end QT now with inflation way above his target. So I think with alacrity, once the economy poops the bed, as I like to say, poops the pants, whatever you want to say, he will cut interest rates back towards zero. He will re-engage in QE. He will relaunch the bank term funding program. And there'll be a plethora of alphabet soup of all of these programs. Helicopter money, I'm sure him and Janet Yellen will kiss and make up. And he'll be monetizing trillions of dollars in treasury debt. But here's the thing. And again, I want to make this point very clear. So the deficit right now is around $2 trillion, $1 trillion in interest. Deficits will blow up to around $6 trillion. If it's like the 2000, 2008 recessions, deficits double. Right, deficits triple, sorry. So they go up by 200%. So you're looking at a $6 trillion deficit, most likely, in this country. $6 trillion. Interest rates would skyrocket if left to market forces. There's just not the savings to supply that. So the Fed's going to have to monetize that debt again. And what's the what is the duration response, the long-term response to Treasury prices and yields, if that is indeed the case? Because either the supply is going to get you or the inflation is going to get you. So yields might not come down short term, yes, but maybe not in the long term. And there's a lot of debt that's priced towards that benchmark Treasury, namely housing. So for LIBOR and the 10-year benchmark.
So you wrote a book, The Coming Bond Market Collapse, back in 2020. And does this kind of tie into that thesis of like, we're creating also a massive bubble there?
So I wrote the book in 2013, predicting that in the future, due to insolvency, the coming insolvency and the coming inflation, that the bond market the bond bubble would burst. Well, I never, even when I wrote the book in 2013, I never dreamed that the 10-year note would go down to 0.33%, but it did. But the bubble in the Treasury complex is bursting as we speak. But what has not burst yet is high yield debt. Corporate debt, in particular junk bonds, have not yet burst. The tightness to Treasuries is razor thin, historically razor thin. The next shoe to drop in the bond market complex is not going to be so much Treasuries, although they will suffer greatly, especially on the long end eventually. And I'm talking about double-digit rate interest rates, in my opinion. But it's going to be the explosion of rates associated with high yield and junk that's going to crush the U.S. economy.
Yeah. My apologies on getting the date wrong. I think I got the audiobook in 2020, so that might explain it. What about gold? Gold's a really popular topic on this channel. What do you think the gold market has been signaling or sniffing out?
Well, so it had to do with three things, in my opinion. First was geopolitical strife. That was contributing to the bid in gold. That's gone away to some degree. We didn't have the World War III start between Iran and Israel and getting us dragged in. So that's not a salient risk at this moment. But there's some secular tailwinds to gold. So the first secular tailwind, and the third leg of the stool for the current bull market in gold, is that internationally speaking, countries are eschewing the U.S. dollar as a world reserve currency. And the reason for that is that due to our hegemony, the U.S. dollar hegemony, there's been confiscations and sanctions against countries that place their reserves, their trade surplus, in the bond market and in the U.S. dollar. So to preclude that from happening in the future, what countries like Brazil and Venezuela and China and Russia are doing is they're, instead of recycling their trade surplus into the bond market in dollars, they're going into gold more and more. And they hold that physical gold. So you cannot put sanctions, you cannot confiscate reserves that are held within your own borders. So if China and Russia were to hold gold instead of U.S. dollars and bonds, it makes them immune from U.S. sanctions. And the third leg of that stool is the fact that real interest rates, it looks, in my view, real interest rates are going to be negative for a very, very long time, protracted in the future, and becoming deeper negative in a negative sense. And so why I say that is because even though inflation is rising on a second derivative basis, the rate of change is rising faster, Powell says there is no inflation problem. There is no stagflation. Inflation is coming down, lumpy, chumpy, whatever he calls it. It's not a linear line. I get it. It's not linear. But he still claims inflation is going back to 2% with the economy's very, very healthy economy. And that means to me that since he's ignoring inflation, so he's putting a lid on, or trying to keep a lid on interest rates, nominal terms, but in real terms they're falling because inflation is rising. And I think that function is going to become more intense over time.
Michael, I know you have a hard stop, and I have to say, even just the 20 minutes with you has been an absolute pleasure. You're making me want to learn more. I want to listen to you more. I would love to have you back on for a more extended conversation if you would allow me at some point, just because what you're saying is so important, especially with the erosion of the middle class, that is so crucial to our country and our future. And I just appreciate you even giving us the 20 minutes today. Thank you so much, Michael.
Thank you, Julia. Appreciate it. You can't have remember this, you can't have a healthy economy or a healthy country, a healthy nation, without a healthy and vibrant middle class. And we no longer have that in this country.
And I think we really need to have that conversation. It's so important. And I really, again, appreciate you, Michael Pento, president of Pento Portfolio Strategies. Thank you so much.
Thank you, Julia.